Holy crap. Did you guys just see the news that the Fed just told more than 30 of the largest U.S. banks that they're preventing them from buying back their stocks and they're capping their dividends?
Mm-hmm.
You may not be aware, but this is big news.
Big news.
So in this video, we're going to tell you why the Fed made this move and 2 reasons why you should care and the potential effect it has on everyone in the U.S., not just the banks.
Stay tuned.
Hi, I'm Nadia.
And I'm Nicole.
The Wealth Twins.
Yes, where we're here teaching you how to invest, make, and manage your money so you can fire your boss.
Yeah, we make new videos weekly, and we would love for you to keep up to date with us. So make sure you subscribe, and you'll know when we put out a new video. All right, so let's get it.
Let's
Nicole.
get it.
All right, I'm going to jump right into it because what the Fed did is a very big move, and it basically reflects their view of the U.S. economy. On June 25th, the Fed told the largest U.S. banks that they will not be allowed to perform share buybacks, and they will have to cap their dividends to no higher than the average quarterly earnings for the previous 4 quarters.
So what does that mean?
That means you are not allowed to spend the extra cash you have on hand right now because you have to save for a rainy day, which will probably be coming in the next 3 months.
Yep.
We're talking about Chase, Wells Fargo, Bank of America, and more. They're putting the brakes on these banks right now of using their extra cash because of the results of a financial stress test that they put on the capital reserves that these banks have to keep up. Right? These stress tests were part of the Dodd-Frank Act that was created after the last financial crisis. Those were like 2007, 2008, right? This is when the largest banks had to be bailed out by the federal government. Banks have to have enough cash on hand right now to weather a financial crisis because they cannot be bailed out by the government again, and it caused such an issue before.
Yep. So, you know what? The Dodd-Frank Act that Nadia has said, it was really put in place with certain rules and tests to prevent banks from ever getting to that point of needing bailout, the too big to fail, right? However, some of the thresholds that were put in place were never really tested quite like they are being tested right now. The Dodd-Frank rules help keep the banks in line right now with what's going on with this pandemic. However, with what we're facing right now, the Fed has deemed that they need to make more stringent tests so they can see how well, these banks perform under different scenarios that we never thought were possible, but could definitely be more likely to happen.
Yeah, it's not enough to just have cash reserves on hand right now. It's more, can you go through and sustain what we're currently seeing? Some of the thresholds they had put in place have already been surpassed with what we're going through in this pandemic.
Right now, we are in a pandemic recession. And on top of that, unemployment is very high and can potentially get higher in the coming months.
Yeah.
So the Fed actually instituted 3 stringent scenarios that they have added to their Dodd-Frank Act. And they're all related to the recovery of the economy and the resiliency of the banks.
Yep. The Fed has stated that the country is most likely going to face 3 different scenarios when it comes to economic recovery because of the strong effects of this pandemic and what it has had on our economy. The first scenario is a quick recovery where it looks like a V, okay? Down, then straight up, when the virus is handled. This scenario, the Fed usually uses to check the bank for resiliency. But now they made the requirement to pass it a little harder. The second one is a slow recovery when it looks more like a U.
Like a U.
Yep. You would have the banks,
they have
business capital declining by 3.9 points, right?
Now, the third scenario, which is the worst scenario, is a W-shaped recovery. So it's like up, down, up, down. This assumes that we're going to have a second wave of coronavirus and also containment measures.
Oh, yeah.
This is something none of us want, but you have to be prepared for it, right? These banks have to have enough cash to handle all of these scenarios. And based on these different scenarios, all the banks passed, but barely. Goldman Sachs and Morgan Stanley are the worst when it came to all these new pandemic stress tests because a lot of their businesses relate to trading activities.
Yeah, they don't have a brick and mortar bank that you can just walk in, like Chase or Bank of America.
Goldman now has a bank, but it's now online. It's online. Now with that, the trading activity, you all know that the market has been very volatile, and it can increasingly become more volatile in the near future. Yeah. So along with the new stress test, the Fed has also set bank dividends that banks use to pay their shareholders should be capped and about what they did in June. Now, you might say, thanks, Nadia and Cole, for all this news. Thanks for the update. But why should I care?
Why should they care?
Well, I tell you, there are 2 reasons why you should care, okay? One of the reasons is buybacks and dividends can hurt the American people in the future.
Yeah.
Buybacks and dividends are part of profits, right? And even though they might not be that big in terms of the bank's overall capital, they are still tied to earnings. If the bank is doing well enough that they're able to hand out some cash and give out to their shareholders, and they're doing a good job of forecasting, then it'll be okay. But if they're not forecasting the same scenarios that the Fed is doing, then we can have a big problem on our hands, and these banks can have a big problem, all right? So if these banks don't take, the full effect of what can happen for them, they might need to be bailed out again by the federal government.
Yeah, they have to plan for some disruption.
And it's not far-fetched.
No.
But if this happens again, who's going to bail them out while the government's helping to bail out people, okay?
I don't think people will really stand by the government bailing out these banks one more
Again.
time. Like, we, as American people, I think we need the bailout more than companies, and it's not acceptable if they have to get another bailout if they weren't managing the extra cash on
They
hand
have
the
to
way
be
they should.
fiscally responsible.
Yeah.
So they have to plan for those rainy days, like Nadia said. And just in case they're not, the Fed is going to say to them, hey, just in case you didn't, we're going to
We're going to put these caps on you.
Yeah. So, banks are a vital part of the economy, and they need to pay attention to their customer needs as well as their shareholder needs.
Yeah.
So capping these dividends and banning buybacks can help these banks continue to be resilient, which they have been through this pandemic. But they need to understand that the recovery that we are expected to go through could be longer than they expect.
Yeah. I already noticed that banks are starting to cut the credit lines of some of their customers.
Yeah, I've seen
and
it too.
we you have to see the writing on the wall, right? If the Fed is running these types of scenarios, you should be concerned. And you got to say, maybe I should be running these type of scenarios too. The Fed is a central bank for America. If they're taking the time to make sure the U.S. banks are getting their money right before September, maybe you should too.
Ooh, say that again.
Here's what we already know. The U.S. could see a second wave of coronavirus in the fall. There was a known error in the reporting of the unemployment numbers. The unemployment figure is higher than what was reported, and they all know about this. There's talk of another stimulus check, and that extra $600 that everybody's been getting in unemployment,
Doesn't it end in July?
that's ending very soon. I think at the end of July, if they don't keep pass another bill.
Yep.
You have a pending election for president, and a lot of seats in Congress are up. And coronavirus is spiking in multiple states.
Yep.
Along with that, all those eviction and foreclosure legislations that gave leniency to people not paying their rent or their mortgages are set to end soon if the Congress doesn't do anything about it.
So basically, what Nadia is trying to say is, if you see the writing that's on the wall, what can happen to these banks can also happen to you. So you have a question that you need to ask yourself while we're sitting down in this time of pandemic. Are you prepared to handle a V-shape, U-shape, or a W-shape recovery scenario? Right? We don't know how long this pandemic is going to last. And although we made some changes and you've probably started making some changes, you have to make sure you're doing as much as you can to get your money right.
Yeah, why not run a stress test on your own expenses and see how much money you should have in your emergency savings account, right? We could be doing what you need to do with your stimulus check and budget in this time. What is the Fed or the government not telling us that we don't know? Because there's enough writing on the wall that we say, oh, something's happening, right? You need to check to see if there are companies that you own in your portfolio, if you have investments that could be adversely affected by this pandemic, especially if it continues like people are suggesting it will. If they are looking strong right now, can it continue to look strong?
How fiscally responsible those CEOs are doing when it comes to their dividends. Are they going to cut dividends? You don't know. But these are questions you should be asking yourself. You have to start thinking critically. All right? We're talking about, we love investing. This could be a good time to invest, but it might not be a good time to invest.
It might be the best time to rebalance your portfolio if you have things that are highly overweighted or underweighted.
Yeah, but what we do know, it's a great time to get your money right.
Yeah, you need to learn how to manage your money, because if the U.S. bank is saying, hey,
banks, manage your money.
Manage your money, which is crazy, then you need to take that as a sign, like you need to get yourself prepared, because we're going to have a rocky road heading ahead of us.
So just to recap, the Fed is banning buybacks and capping dividends. We have to take all the different recovery scenarios that they have given out into account.
Yep.
And American economy depends on these banks not being bailed out and also being resilient so they can give out loans, so small businesses can get loans, so credit can still be available. These banks are essential to our economy, and they have to do what they need to do to make sure that everybody recovers from this pandemic.
Yeah, the Fed is expecting these banks to be resilient. We want you to be resilient also in this time. Run some stress tests on your own finances, all right? Our goal is to give you the info and the skills to help you succeed in the good times and the unexpected times so you're not caught off guard.
Yep. And as always, we want you to remember, your manners will take you further than your money.
Yep. Check out the next video.
See you guys.